Hey guys, welcome back to the channel. So I get this question asked a lot of times that can you buy a car before buying our house? Especially with first time home buyers, there's a stigma attached to buying a car. And even though I'm all for buying a car in cash and keeping your payments as low as possible, it's completely not true that you cannot have a car payment when you can buy a house. So in today's video, we'll be talking about should you buy a car at all? The second thing that we'll be talking about is how much car should you buy depending on your salary. And the third thing that we'll be talking about is how does it impact your mortgage eligibility? And that's the most important question that I want to answer because there's a lot of misinformation around cars and houses, and we'll bust all those with numbers. So let's get started. So every new immigrant has this first question that they want to ask whether to buy a car, how much to buy, would that impact our eligibility? So do we buy a car before we buy a house? And the answer is yes, absolutely, but it also depends on your personal situation. For example, if you have kids, if you have more than 2 kids especially, it would be much more convenient to have a car. Yes, of course, you don't need a $1,000 car payment. You need probably a car that you buy in cash or probably the cheapest car like we bought Elantra. We'll be talking about that and the payments, for that. And that's something that you can go for, but the biggest thing is your personal situation, and the first thing that you need to consider is do you have kids, and the second one is will you use the car for work. There are certain jobs that require you to have a car. For example, if you are applying for a sales manager, let's say in one of the companies like a telecom company, you would be required to have a car, and yes, the fuel will be paid by the company, but you still have to maintain those car payments. And then there are certain other people who will use the car for their work, actual work. For example, students actually buy a car and then use it for Uber. They actually do deliveries on Domino's. So all those considerations need to be taken into account when you are taking a decision to buy a car. And the third one, and this is probably the most important one, and we'll be talking about that not just here but in the last slide as well, is that are you buying a car that's not too expensive? That's the most important thing, and I always go with the rule of 10, which is your car expenses should not exceed 10% of your net household income. So if you are making $10,000 combined, if you have 2 people in the household who are working and they are making $10,000 net income, you should not have your expenses of the car to over $1,000. That includes your car payment, your car insurance, and the fuel related expenses. I'm not even counting the winter tire changes, the maintenance in this. I'm just counting the 3 biggest expenses that you will have every single month: your insurance, your payments, and your fuel bill. And the reason why rule of 10 is important is because we should not be joining the herd, joining the majority of people who have a high car payment. We are much smarter than that, because an average car payment in North America is $700 a month, and that's just the car payment. You have insurance and fuel on top of that, and the average net household income in Canada and North America is nowhere close to $100,000, and that's what it requires to have a car payment of over $500. And people who have high car payments are the first ones to not invest into stocks, into assets, and because they have a lot of their money locked into a liability, which is a car. Just imagine if instead of buying a $700 car payment, you were to invest the difference of your car payment, which is $400, $450, just some car that you have that takes you from point A to point B, and you invest the difference of $200, $250 into stocks, ETFs, that will grow in value. And especially as a new immigrant, if you're trying to buy a house in the next 12 months, 24 months, having a car payment of higher than $500 will impact your mortgage eligibility in a really big way, and we'll discuss that with an example as we move along in this presentation. And a lot of people actually forget the fact that car payments are not the only expense that you have with a car on a monthly basis. For example, we bought a Hyundai Elantra. It was a medium model. It was not the high end. It was not the lowest end. It was a medium model. In 2020 is when we bought. The price of the car was $27,000. It has not increased a lot with inflation. $28,000. It's pretty amazing, and the features are a lot more in 2023. So $1,000 is not a big increase. However, the difference is that we bought a car at 0% 84 months. So we took a loan for 7 years at 0% interest rate. Whereas right now the interest rates are at 6.49% for 84 months. It will be much higher if you go with a higher amortization. Monthly payments were $325 a month. That's the payment that I pay every single month. However, the same payment for the same car, almost the same price, because of the high interest rates, will be over $400. So you have an entire $100 more that you are spending, but that's not the only thing that you're spending. And the important thing to understand is car payment is not the only expense that you have with the car. You also have insurance, which for me is $280, was $280 when we started, when we were new immigrants, and most of you who are coming will be new immigrants. So you need to budget about $250 to $300 if you're coming to Ontario. It could be a little bit more if you're living in places like Brampton, but it could be a lot less if you are living away. For example, when I moved to Cambridge, like Kitchener, Cambridge, my car payment reduced from $280 to $160. Yes, I also gained more experience. I have now driving experience of more than 2 years in Canada, but the place also impacts a lot, but that's an expense that you need to budget when you are buying a car. The other expense that you need to budget is fuel. When we came to Canada, I think I remember 80 cents per liter is what I paid, the lowest. But right now it's almost 160 cents or $1.60 per liter, and that's expensive. So fuel, even if you assume one full tank per week, and if you're traveling, it'll be a little bit more. It'll be about $300, and I'm only talking about my car, which is Elantra, which has excellent fuel efficiency. And what that comes to is monthly expense of $900 if you bought this car in 2020, and if you're buying the car next year, which is 2023, you will be paying $100 more, close to $1,000, which is more than 10% higher in cost. And as per the rule of 10, back in 2020, you should have had the household income after tax of $9,000. That was very close to what me and Simran were earning along with our side hustle income. And right now you would need almost $10,000 of after tax income household in order to afford this car. And this is not a very expensive car. This is in fact one of the cheapest cars that you can buy new. Now, before I move on to a strategy that you can use to meet that rule of 10, even if the car is more expensive than your household income, I would like to give you a pro tip that I used when I was buying a car. So I had an option of buying a Toyota Corolla and a Hyundai Elantra. Now, a lot of people said, no, you should have gone for Toyota Corolla because that has a higher resale value. When I'm buying a car, I'm not looking at resale value. All I'm looking at is it's a liability, and I need to reduce my monthly outflow for that. So the payments were almost the same. I think $325 for Elantra, and it was about $335 or $340 for Corolla. So it was not very different in terms of payments, but the insurance was $280 for Elantra that I bought when I bought it. And the same insurance for Toyota Corolla was $350, and that's where I saved $70, and that was my decision maker, because if I pay $70 more for the next 7 years, that's a lot of dollars that I was not willing to give away in insurance. So always call the insurance company before you buy the car, because different cars, depending on the location that you live in, can have different insurance quotes. You can actually save about $100 a month on car insurance. Now, coming back to the rule of 10, what if you aren't meeting the rule of 10? What do you do then? One of the things that you can absolutely do is buy the car in cash, but that's not realistic. A lot of people actually say you should buy a car in cash. I will be buying my second car in cash, but that's only when I earned that cash while I was in Canada and I could afford to buy that car. But when we are new immigrants, we should actually not look to buy a car in cash unless we are buying a used car. And I'll talk about that in a bit. However, if you are coming from a place where you actually made a lot of money and you are coming here with over $50,000, I would highly recommend that you actually consider buying a new car in cash, because the interest rates on the loans right now are over 6%, and I don't think it's worth paying that much for a car that only takes you from point A to point B. The second strategy that you can actually use to fit into the rule of 10 is actually a little bit different. It's all maths here. So can you make more money? And when I say can you make more money, I'm not saying from your job getting a hike or something. So I met a person who is earning $5,000 net income after taxes, and he's single, therefore the household income is $5,000. Now this person was a student, and therefore he wanted to buy a car just to explore Canada a little bit more, and his car expenses are very similar to mine, which is $1,000. So therefore this is 20% of the household income. This is nowhere close to rule of 10. So the ideal car expenses would have been $500, and his point was that there's no way in hell that I can get a car for $500, and he is right. You cannot get a new car with all the expenses, including the car payment, the insurance, and the fuel cost just cannot match the $500. So his view on this was that he can actually reduce the car related expenses by increasing the income from the car. So in the evenings and on the weekends, he started doing Uber, and his net Uber income from Uber Eats and Skip the Dishes was about $700, and his net of car expenses was $300. So $1,000 that he was paying in car expenses, and he was making $700 from that car, and therefore the net of expenses were $300, and now he's down to 6%. So he's down to less than 10%. Now, obviously, he's trying to artificially reduce the number, but I found this to be a very effective approach in a place where you cannot earn $10,000 or $12,000, but you really need a car to do whatever you want. Whether you have kids, whether you are a single earner, you can always work extra hard in order to make a little more money with the car that you have. Now, I do understand that driving an Uber is not always possible, and therefore I would recommend that if you really need a car, then you can buy a used car instead of new. And if I were buying a used car right now, I would buy a Toyota, which is accident free. So you do need to have a Carfax report. Make sure that the seller or whoever you are buying from has a Carfax report and it's run for under 100,000 kilometers. Now, even if Toyotas can run over 100,000 kilometers, you always have some maintenance gaps after 100,000 kilometers. So try to stick to these parameters. Those are at least the parameters that I would follow if I were buying a used car right now. But the second point that I talked about, making more money with the car, is the best way of sticking to the rule of 10 while still having a car to explore Canada. So now comes the big question, can I buy a car before buying my first house? If you're buying a car in cash, absolutely you can, because your mortgage eligibility does not include your car insurance and your fuel cost. It's just me putting it in the rule of 10 because that's important from a budgeting standpoint. However, it's not important from a bank standpoint to include your insurance and your fuel. And therefore, if you're buying in cash, it's all good. However, even if you are buying on finance and lease, you can buy a car, but what matters is that you do not buy too much of it. So now let's talk about how do banks look at cars when buying your first house. And there are two ratios, and now things will get a little bit complicated. Just bear with me. The first ratio that they look at is called gross debt service. It's called GDS. GDS basically means your qualifying mortgage payment. So whatever mortgage you have on the house that you're buying, plus the property tax, plus the utilities, and I'll explain what qualifying mortgage payment is and what mortgage payment is in the next slide. But your mortgage payment plus property tax plus utilities, that's the house carrying cost per month divided by your gross monthly income for the household. This is before tax. So if I'm making $100,000, $120,000, that would go in the denominator, and this ratio should be less than 39%. So this basically means that your house carrying cost, including your utilities, property tax, and mortgage payment, should not exceed 39% of your gross monthly household income. And this particular ratio, GDS, does not include any other debts into account. Your student loans, your car debt, all that is not included. There's a second ratio that's important, which is called TDS, which is total debt service. This total debt service has everything that's there in GDS, your qualifying mortgage payment, your property tax, your utilities, but it also includes your other debt. Now, I'm hoping as a new immigrant, you would not have any other debt except for the car debt that you're looking at. So if you include your monthly payment for the car, again, you only include the monthly payments for the car, the EMI, and not the insurance and the fuel cost. Divided by the gross monthly income, this should be less than 44%. So what that does is that it gives you a 5% room in terms of ratio to your gross household income in order to buy a car. Let's see how it translates in the form of an example. Now let's assume that you have a gross household income of $120,000 a year, which is $10,000 a month. You are buying a house for $540,000. You are putting a $60,000 down. Your mortgage default insurance, because you're doing a less than 20% down, there'll be a mortgage default insurance, which is also called CMHC insurance, is $14,880. Your overall loan that you're taking from the bank is $540 minus 60 plus $14,880, because this mortgage insurance gets added on to your overall mortgage and the loan. And your overall loan will be close to $495,000. The interest rates right now, as of today, are about 5% at 25-year amortization, and the mortgage payment becomes $2,878.25. Now comes the kicker. When you are applying for a mortgage, they don't qualify you at the mortgage rate that they have right now, but they qualify you at something called as a stress test or a qualifying rate, which is 2% higher than the rate that you are getting. So your mortgage payment will be at 5% at $2,878. However, the bank will qualify you at plus 2% of your rate, which is 7%, and that's called a stress test. That doesn't mean your mortgage payment will be 3,466, but they want to qualify you at 3,466. So let's put GDS and TDS into perspective. So you have your qualifying payment at 3,466. That's why it's called qualifying payment, because it's not your payment. It's what you qualify at plus 2% and the stress test. The property tax, let's assume it's $300 a month, $3,600 a year. Utilities, let's cap it at $125, but because most banks actually cap it at $125 a month. So the GDS will be addition of 3,466 plus 300 plus 125, so 3,891.22 divided by your gross monthly income. which is $10,000, and that brings us to 38.91. And like we said in the previous slide, it should be less than 39%. So we are okay to buy a house of $540,000 with the parameters that we have taken if you are earning $10,000 gross household income every single month. Now let's assume that your car payment is $500 a month and your TDS now becomes 3891, which is your qualifying payment, property tax, utilities plus your car payment. It increases to about 4391.22 divided by the gross monthly income, and now we are at 43.91%, and this should be less than 44. So GDS and TDS are less than 39 and 44, and that means that you can actually buy this house. However, in the case where your car payment was $200 more or $100 more, what that would do is that our TDS will now go past 44%, because now our overall this number, which includes all our debt, including the house debt, plus $700 instead of $500 will be 4591 divided by 10,000, which is 45.91%. And what that means is that we'll have to reduce something. We already have the car, so either you sell off the car or you pay it off or you refinance the car, and that's a much more complicated process. You cannot do anything with the property tax, you cannot change the utilities. The only thing that you can change is your qualifying payment, which actually means that you're buying a house with a qualifying payment of $200 lower. What that translates into the loan is almost $28,000 lower on the loan that you can take, and that basically means that your house buying power has reduced to $512,000 instead of $540,000. So even if you were qualified for a $540,000 house, just because your car payment was $200 more, it was $700 instead of $500, you are not able to buy the $540,000 house. And that's the impact that high car payments have on mortgage eligibility. And therefore, it's complete misinformation when people say that you should not buy a car before buying your first house. But a better way of saying that would be that you should not overbuy your car before you buy your first house. Now, your maximum car payments will actually vary depending on your household income. So this is a table that I just made. This is just customizing. If your income is, say, let's say $50,000, that's gross household income annual before tax. If your income is $50,000, then you should have a maximum car payment of $200 in order to make sure that your GDS and TDS ratios are aligned at 39 and 44. So the max car payment should be $200, and you'll see that as your income grows by $25,000, your car payment also increases by $100. So if you are earning $75,000, it will be $300, $100,000, it will be $400. So as you increase your household income by $25,000, you can now buy $100 more of car. So there are a few assumptions that I'm taking here. The number one assumption is that interest rates I'm taking are current interest rates of about 5%. Down payment is about 10% that I've taken. There are no other debts except for the car that you have, the car that we just discussed, and the home that you are buying. And this income that I've taken is full-time income and not part-time or contract income. Now guys, I am a mortgage agent, but I'm not your mortgage agent, and therefore we need to make sure that we are talking to someone who knows what they're talking about. They're taking your car into account, they are taking the right numbers, and they're giving you the right eligibility. And just know that if you have a car payment of over $500, make sure you book a call with me before you try and go to buy a house, because we need to understand how much of that higher car payment is impacting us on our eligibility. That's all I have for today. I hope you like this video. This is the question that has been asked on the channel, in our chat boxes, on my Instagram, and with my clients as well. So I hope you got some idea and I was able to demonstrate with numbers what's the ideal car payment. In my view, you should not have a car payment of over $500. The lower it is, the better it is, especially if you're not, you're not just buying your first house, right? When you're buying your second house, your TDS actually includes your first house as well. So when you're buying more properties, your 5% range of 39 and 44 also has to include other properties. So make sure that you're reducing your car payments to as much as possible so that you can buy more real estate in future. But if you're only buying your first car, 500 is the magic number, assuming you are making anywhere close to $100,000. Do subscribe to the channel if you're not done that. मिलते हैं अगली वीडियो में, तब तक के लिए बाय बाय.